Good evening and hearty welcome to all of you. At the outset, I am very grateful to all of you who have highly knowledgeable professionals have joined here for a very meaningful and purposeful discussion on two important aspects of the recent circular by the Reserve Bank. One is on self-regulatory organization in the financial institution, how SRO can play a very important role. I will have my own speech limited later. So second is climate risk. Today is the day of climate risk. Everywhere you find. So even on the credit policy, climate risk will have an impact. You would have read the state of the economy article by the bulletin in the recent April. There is a special mention, the heat wave or this type of climate risk is going to have impact on our food production. And all of you are seeing the last year 2023 has been the 1,20,000 years में highest heat wave और वो अभी भी is continuing. So in view of that, how that will have an impact on the banks in terms of two risks. One is physical risk, another is transition risk. So in view of that, RBI has also issued a circular on what are the climate related disclosure on the baseline as well as on the enhanced disclosure. All the banks and all regulated institutions will have to follow. And in view of the deadline also given, and it may be now draft, but it is likely to come on a full pledge. So on this subject, I am very glad that all of you responded, and we have a very good speakers. Now, as the opening welcome address, I request our Samir Somaya, President of IMC Chamber of Commerce, and he is all of you are aware that the Somaya University, and he is also in the health, he is also in the what you call education institution. So he is a well-known figure, and we are all glad that he is occupying the IMC presidentship for the current year. With this small introduction, I give the forum to our president. Yes, sir.
On behalf of the IMC Chamber of Commerce and Industry, it gives me immense pleasure to welcome you all at the panel discussion on RBI guidelines for SRO and preparedness for climate-related disclosure for banks, organized by the IMC's Banking, NBFC and Finance Committee. A very warm welcome and special thanks to our esteemed panelists. Mr. Naveen Surya, Member Banking, NBFC and Finance Committee, IMC and founder and former chairman, FinTech Convergence Council, Chairman Emeritus Payments Council of India and strategic venture partner, Beams Venture Fund. Mr. Paliwal, CEO, Association of Small Finance Banks of India, Secretary General, Currency Cycle Association, former Executive Director, RBI, former Director, Supervision, Bank of Mauritius. Mr. Bansal, Managing Director and CEO of Edelweiss Asset Reconstruction Company Limited. Mr. Harihara Mishra, Member Banking, NBFC and Finance Committee, IMC and CEO, Association of ARCs in India. Mr. Jitesh Shetty, co-founder, CEO of Credible ESG. Mr. Sajal Kishore, Managing Director and Head of Asia Pacific Infrastructure and Project Finance Rating Groups, Fitch Ratings. Ms. Hina Khushalani, Partner Climate Change and Sustainability Services, EY India. Mr. P.D. Singh, Co-Chairman Banking, NBFC and Finance Committee, IMC and Bank CEO, JP Morgan Chase Bank. And dear Dr. Narendra, Chairman Banking, NBFC and Finance Committee, IMC and former CMD Indian Overseas Bank for sparing their valuable time and being with us today. Reserve Bank prescribes necessary regulatory framework for its regulated entities, REs. With the growth of REs in terms of number as well as scale of operations, an increase in adoption of innovative technologies and enhanced customer outreach, a need was felt to develop better industry standards for self-regulations. Self-regulatory organizations, SROs, enhance the effectiveness of regulations by drawing upon the technical expertise of practitioners and also aid in framing, fine-tuning regulatory policies by providing inputs on technical and practical aspects, nuances and trade-offs involved. SROs can also help in fostering innovation, transparency, fair competition and customer protection. In sum, self-regulation shall complement the extant regulatory statutory framework for better compliance in letter and spirit. And as a person in various industries, sir, I think it would also give lessons for such organizations to work in a wider variety of fields because it will complement existing regulations. On March 21st, 2024, the RBI only last month has announced an omnibus framework for recognizing SRO for regulated entities. In pursuance of the announcement made on the development and regulatory policies released along with the monetary policy statement on February 8, 2023, the RBI has placed on its website the draft guidelines on disclosure framework on climate-related financial risk 2024. These guidelines shall be applicable to all scheduled commercial banks, excluding local area banks, payment banks and regional rural banks, all tier 4 primary urban cooperative banks, all India financial institutions such as Exim Bank, NABARD, NAB, FID, NHB and SIDBI, and all top and upper layer non-bank NBFCs. The RBI has invited comments on draft disclosure framework for climate-related financial risk 2024 by April 30, 2024. So just on, I'm also, my primary business is it's an agri business. And so we see climate very closely. We track water levels in the dam almost every 2 weeks. We also track soil carbon to find out, because if the soil carbon vanishes, our food will also go away. So I think it's, and we see, the effect of lack of carbon, lack of water, and its effect on directly on, of course, our food and, of course, later on our energy. So I think it's very important, not only for banks, but later on for all businesses. Today's panel discussion on RBI guidelines on SRO and other panel on preparedness for climate-related disclosure for banks will have experts giving clarity on these two important developments concerning financial institutions. In conclusion, I would like to thank Dr. Narendra, Chairman of the Committee and former CMD Indian Overseas Bank, Mr. P.D. Singh, Co-Chairman of the Committee and Bank CEO, JP Morgan Chase Bank, and our Association of ARCs in India. With these few words, I welcome you all today to today's panel discussion. The topics, I think, are very thought-provoking. Before I conclude, a few words about the IMC. Established in 1907 and having its headquarters in Mumbai, the IMC Chamber of Commerce and Industry is an apex chamber of commerce, trade and industry in the western region with a membership base of over 5,000 members and over 150 associations affiliated to it. Together, it represents and advocates the interests of over 400,000 business and industry establishments across the country from diverse sectors of the industry. The theme for the year is Partnering for Sustainable Growth. I once again welcome everyone to an insightful interactive session. Thank you.
Thank you very much, sir, and for your valid points. And as you rightly said, every corporate, every senior or responsible citizen should be aware of the impact of climate risk. So in that respect, more than 1,000 companies listed in the BSE have already been mandated, and they have been disclosing the business responsibility reporting systems. So with that, I had already mentioned. So in the SRO, that we have experts here, Naveen Surya, Hariyar Mishra, Paliwalji, and Mr. Bansal. And so this, how this is going to improve the functioning and orderly functioning, the compliance culture, as well as the ethical and moral aspect, and how you will be supplementing the efforts of the regulator in arriving at a what you call a ideal system. And moreover, sector wise, this is the Omni, I think, is a framework. Sector wise, there will be a separate again guideline coming from the RBI. We knew of the fact that you would have heard when the FinTech Festival Global, our RBI said within the next 1 year, we need to have a SRO for FinTech. So that is also likely in the offing. and I am sure globally also there are quite a lot of companies, particularly in the securities market also. There are which are acting as the SRO. So this even in the resolution mechanism, instead of depending on externally, this organization can work similarly in arriving at the standards of practice, global benchmarks, or in getting the best practices, and also working as a research wing for the industry. That is a for the common benefit. So if I cover that, our others know they will be bringing, but these are all very important. Fair practices are very important. So that is on the SRO. As far as the our climate related risk, RBI has issued a circular long back. Kindly have a assessment from their current portfolio and arrive at from the credit risk angle, or from the market risk angle, or on the operation risk angle, or on even including in the strategic angle, how these risks are getting on your current portfolio, and also be ready for arriving at the physical risk as well as the transitional. What is the physical risk? That is, due to this climate risk, if the entire portfolio of the bank or in relation to, they suffer physically, and there will be a financial loss to that. It is a direct loss. Whereas the transition loss is in view of the government net zero impact, the moving from the fossil fuels to the alternative energy, or in getting into the other adoption and what you call mitigation plan. What are the changes coming in that? That will also will have an impact on the banking fraternity. So in view of that, both the risks are to be assessed, and then you have to have the risk assessment in terms of scenario analysis as well as stress testing. And you should have enough buffer capital in your ICAP exercise also, because so far you would not have done. Now the climate risk also will have a factor when you are arriving at the ICAP exercise. So the regulatory capital as well as economic capital will have to be in such a way that these risks, and I am of the opinion that these risks are already affecting. Second is, if the corporates or others approach the bank, today banks have already started asking a lot of questions, and without knowing what is that for a alternative, come madam, please, alternative, whatever, if they have not gone, the emission and other things will have a definite impact on the such a high exposure to the corporate which the banks are giving, or even on the market on raising bonds and other things. Similarly on equity, today it may so happen corporates on their equity requirement, some of them may not invest if they are not compliant with the what you call emission requirements and all, or green emissions, or in emissions control if there. So in view of this, these two subjects are very relevant, and I am very happy all from the relevant audience are here. So I think all our speakers, you will be getting quite a lot of questions from them. They will definitely like to get fully what you call engaged in that. So it will also, we may try to some of your suggestion and all that we may give as a back to our regulator, so that before 30th April on the these draft climate related we have to give. Whereas the framework is already there, but our ARC association is also one of the organization. Our FIDC, where our Mr. Mahesh Thakkar is a vice chairman of this, he is also one of the organization. Our IBA, where our Madhava Nair is the honorary secretary. So they are all represented here. IBA, all of you know, Indian Association is already one type of very regulated SRO. So they are the most, the government and the regulator is always looking to them in term. So they are looking to. Okay, we will later arrange another extra chairs, please. So with this small introduction, now we will hand over the next discussion on SRO to Harihara Mishra. He is the ex-banker from the very senior from the what you call State Bank of India, and currently he has been taking active interest. He was also one CEO of one of the ARC company, and today he is the secretary of ARC Association. Now it is forum for you. Yeah.
Good evening, Mr. Somaya, President IMC. Narendra, Mr. Navin Surya, Bansal sir, and Mr. Paliwal. Ladies and gentlemen, last month Reserve Bank of India has come out with an omnibus guideline on SRO, which is applicable to all the sectors. Why it has come out with the guideline, the rationale is that there is a lot of innovations taking in the financial sector. The outreach has gone substantially, and there is a felt need that the industry regulation standards has to be commensurate with the developments in the industry. Before I hand it over to panelists, let me have a brief overview of the SRO concept. In the financial sector, the earliest SRO has been London Stock Exchange in the 18th century. And in fact, for every stage of the evolution of a sector, there are 4 categories of rule applicability. First, there may not be any rule at all. Then comes self-regulation. Then when it assumes some systemic importance, there is a state regulation or regulation by government. And the final stage in the evolution is where there is a state regulation supplemented by self-regulation. And that's where we are in India and most of the countries now. There is a set of regulators, but in addition to that, they want regulations by the industry themselves. So we have sector specialists from fintech, from currency, from ARC, and we would like to take their view on the recent guidelines and how does that impact their sector, and how do self-regulations complement the regulations within the sector as regulated now. So with this, I start with Mr. Navin to my right for his initial comments.
Hi, good evening, everyone. I think I'll keep my initial remarks short so that we have more time with the interaction and the questions from the audience. And I think a lot is already covered by Hariyara sir and Narendra sir about the SRO. Only thing that we have to understand that SRO is not a new subject for Reserve Bank of India. There has been SROs existing already in MFI sector, already in a forex sector. So what has triggered this omnibus? I think the only key reason has been the sector probably that I'm representing, fintech. If you see the number of companies and the pace of change that has happened in last decade and a half, and especially last, let's say 5-6 years, starting with the COVID period, I think the number of entities, which again, different numbers are in different reports, 7,000 to 15,000, and the kind of business models, practices continuously changing, technology continuously changing. It becomes a huge challenge for both regulators, industry, and let's say all the stakeholders to maintain some sort of a standardization, discipline, risk. So I think it has been a continuous discussion with various industry forum as well as the regulators that this is a time probably while we have industry association, but industry associations will always be seen fighting for their business growth objectives. They will not be necessarily seen balancing the public good, while regulators would look at from a purely supervisory and regulatory aspects. So a balance needs to be drawn, and probably SRO could be good framework. So if you see the initially, even pre-COVID, the payment SRO guidelines were already there, even before Omnibus had come. Draft guidelines for a fintech SRO has already come. And by the way, while the title says regulated entity, but fintech SRO draft guidelines talk about even entities which are not regulated, but let's say working under regulated entities. So broadly, I think this is to deal with the dynamic changes that are happening at the right pace and drawing a balance between, let's say, developmental activities, regulation, supervision, at the same time, some sort of orderly growth. So I'll stop here and probably go into other questions.
Now I would request Mr. Bansal sir to have his initial remarks.
Yeah, good evening. As Naveen said, the SROs in some shape has always been there, whether you call them associations or whether you start with IBA or MP or TIMDA or FIDI. No? I'll come this side. Okay, thank you. So, as Naveen said, the SROs in some shape has always been there. And guidelines of Reserve Bank have always been there to some extent. Whether some of the SROs do have those powers which RBI is envisaging now in the draft guidelines is a matter for discussion. But otherwise, start with MFI or IBA or FIMDA or FIDI or for everyone. So some of the sectors as FinTech, I think already started where the number is too large. In ARCs, of course, the number is very limited, but for NBFCs, we have FIDCs. So what we need to see is that RBI is moving in a different direction with SRO guideline. It expects a board, etc., independent director, so it expects a different type of setup. I think we will discuss that in detail, but otherwise, the idea is good. How to implement, and the implementation would be an issue and a challenge. I think I'll stop at that. We can discuss later. Thank you.
I will now request Paliwal sir, in fact, he comes from Reserve Bank also, so he can have a blend of both regulators' perspective as well as market participants' perspective.
Thank you, Mr. Ji. A very good afternoon or evening, the way you look at it. So, actually, if we start with the industry bodies, they have been there from the beginning. If you look at the SRO with the banking regulator as such, it started after the 2010 crisis with the MFI sector, and then MFIN and SADAN came into being. These are the regulated entities, in a way, partly regulated, partly of it deriving the regulation. Secondly, for the unregulated sector, the third thinking was for the currency management, when it was like, say, voluntarily, like you could form the association. So I was associated with and remained with the Currency Cycle Association, where the RBI gave 1 year for the SRO to be formed. Personally, I believe, and might be that because I still continue to wear the regulatory hat, they say once a doctor, once a trainer, you remain. So the regulator also, the same thing applies. So we were given 1 year. We were the unregulated entities. The regulated ones were the banks. We seized the opportunity. When I'm saying so, you may call it arrogance, but our members got together and they were the last rung who were serving the filling of the ATMs. We did it in a span of 5.5 months, 6.5 months to spare. We went to the RBI and said that we have formed the SRO. Subsequently, when the timeline came of 31st of March 2019, which was 1 year, the others woke up and said, we would like to form an SRO. RBI said it's already formed. So what I'm saying is that the need has to be felt by the industry. In this case, possibly you can have either a pull or the push. Push has already been given now by the RBI to everyone, whosoever is there. Pull has to be there. If we want to be the leaders, which we are all here, and we represent, ideally is that you become the innovator. There would be challenges. Independence is first part of it. The chairman has to be independent. 1/3 of the members have to be independent. Transparency is the key. Grievous redressal is going to be another issue. Financing by the members as envisaged as of now is going to be a challenge, because the people who are going to contribute and then you are going to regulate them under the self-regulation is not an easy task. It's like the parents providing the money and then you say, no, you remain regulated. Child will have to listen sometimes to the parents. So that could be another issue. A challenge, I'll say not an issue, but a challenge which over a period of time will get covered. And the last and the most important part of it, that once we feel the need of it, initial part is the pain. Let me admit it. Because regulation is the most difficult and self-regulation is still more difficult. Otherwise, you always blame it on the regulator. There is a traffic light, a signal, okay, I'll be caught by the camera, okay, I'll have no option but to be there before the zebra line. But if I have to do it in the middle of the night, when there is no camera, there is no policeman, and there is no one to watch me, and if I do it, I think then life becomes easier for everyone. And that is what the SROs are there for, and they are going to be there for all times to come. So the earlier we start getting used to it, the better it is. And the most important part of it is it's voluntary, as opposed to the regulation. Regulation is like, say, you give and apply for a license, regulated entities get the license. So the relationship is that of a regulator and a regulatee. That's totally different from a voluntary organization where the members have to feel the need. They have to see the advantages, and the advantages outweigh the cost of compliance. Compliance is always costly, non-compliance is costlier. I'll stop it there, and as we go through the subsequent part of the discussion, and it is a learning experience for me, I can tell you, it's 5.5 years of the SRO, and prior to that on the regulator side when we were dealing with Sadhan and MFIN. One thing has to be there is, friends, never have the industry body and the SRO together. They should be always distinct. You wear the same hat, the regulator will always be confused, and the associations would be still more confused. You seek an appointment, they'll say, whom are you representing, industry body or the SRO? I said, no, industry. Okay, fine. Then you are like Oliver Twist, please do keep on coming, asking for more. You wear the regulator SRO hat, you start talking again of the industry, they say stop. So it's always better to have an entity which is separate, not at an arm's length, completely separate. Members would be the same, but the job is different, and then the credence which it gets, the credibility which you get, the regulatory frequency with which you can meet and interact will be totally different, and you will be at a totally different pedestal as opposed to an industry body. I work with both. Thanks a lot.
Each sector has its own problems, its own nuances. Now we'll get into. Hello, now it's working. So now, from this omnibus framework of SROs, we have picked up 3 important and critical areas which will determine the SRO's effectiveness as well as governance structure and its meaningful interplay with the regulations. These 3 are: 1, code of conduct and best practices; 2, dispute resolution and arbitration mechanism; and 3, surveillance methods for effective monitoring of the sector. Now I would like to hear from the sector specialist about their thoughts on these 3 areas broadly. We start with Navin. Thank you.
I think of the 3, probably they are, if I had to say that, okay, which one is going to be more challenging, they are in the same order actually. The first one being the easiest and the last one being the most difficult and again, my experience is more as an industry body and of course the player in the industry. So code of conduct and best practices are a common bread and butter of every association. They always do it. In fact, that's how somewhere the even seed of why do you need SRO is also arising. Because we've seen multiple times that you prescribe a code of conduct, every member signs up, but ultimately they're your commercial member. Somewhere if somebody is not following it, what can you really do about them? At best, you can fire them as a member. It doesn't mean that they have stopped the practice, right? And many times it also becomes difficult if they're too big, they're too influenced, if they are, let's say, high contributing members. Because ultimately it's still run by the, let's say, the commercial part of the organization, even though you are a not-for-profit body and association. There is definitely a degree of influence. So first part is easy to kind of do, but enforcement was a challenge. That's why the SRO was required. Hopefully that part gets fixed, that you can start at least taking some sort of a proper enforcement actions, or at least recommend to RBI if you can't do it directly. So first one I think is definitely very much on the card and should be easier, and everybody wants to do it, and that's required. But that also saves the industry face, because a lot of time the RBI guidelines or a action comes in when a couple of players are not following something, which could have been salvaged because it's known to the industry well in advance. They themselves can stop it voluntarily well in advance to actually save the bigger damage. The dispute resolution and arbitration mechanism, I can talk about my sector. I don't think any of our industry segment, let's talk digital lending, let's talk digital payments, they have really played that role in an association yet. So that will be a new area for them to work. Obviously, they will have to take expertise help. And like Paliwal sir said that, I think RBI clearly has mentioned that there has to be a separate, clear, independent entity. And hopefully there will be experts dealing with it. But at times that is not an easy area. That will be a new learning for all of us from our sector perspective. The last one is actually the toughest one. The reality is that whatever you do, there will always be some cases that you would not be able to identify. And the moment you are a SRO and if something slips by, definitely you're going to be questioned as a SRO by, let's say, RBI or any other authority that what were you doing? And probably that's an area where a lot more automation and technology help will be required. Rather than, we can't create another CBI kind of organization, right, as a SRO. That's not expected of SRO. You can't create investigative bodies to go after every entity and see what they're doing. It's not possible, especially in the sector where, let's take an example, LSPs. Let's say though they're not regulated, but they're sub-regulated. Numbers could be in thousands. How do you identify? I mean, we've already seen what has happened with illegal apps where the government directly fighting and we are still struggling. How do you stop? Because it is not just about your own industry. It's also, let's say, things like app stores, who actually onboards them first. And it took actually all of us to talk to government and regulators that your illegal app action, even if you take within the industry, it won't solve it. It is beyond the industry. It includes MeitY, it includes all other technology service providers, including ISPs. Unless you get cooperation from them, some of those risks you cannot. So the last area is going to be the most trickier one. And I think the answer will lie in the technology. And I think simpler way, my personal suggestion would be that more and more data collection that is done by SRO. Probably you could find some early signals and probably from there you could start thinking about some additional activities. Those are my initial brief comments on these three areas.
Now I pass it on to Mr. Bansal sir. The same questions, omnibus questions, actually because omnibus framework hai.
So my job is simpler for ARC in that sense as compared to Naveen. We have limited numbers of members and unlikely to increase too much. Fintech is a growing sector and then you can have different apps or different products. In ARC is a slightly stale type of business. So I think as compared to his saying third will be more difficult, for us I think the most difficult part will be the first one. Because if you have to have a code of conduct which members have to follow. So RBI has already issued a fair practice code for ARC industry. So already it is known that this is the fair practice code. So you can work on it and improve upon it. The challenge would be if somebody is not following that. And as we are discussing, association has to be different than SRO. So, and number of ARCs being limited, I think that will be the biggest challenge, that how do you enforce the code of conduct and how the members follow that. And similarly, the second part is dispute resolution, which are of course as of today disputes within ARCs are much less. Hardly we see any dispute within ARCs except maybe sometimes if two are bidding for some asset there could be some minor dispute. Chances of dispute arising between ARCs again will be less, like say chances of dispute within NBFCs are also less that way. So I think for us the biggest challenge would be the first one, the code of conduct and best practices. I think it can be done because RBI has already issued some fair practice code, settlement guidelines. So it's more of how to enforce or how to implement those throughout the sector, that all the members should follow it. Thank you.
Well, if we start with the number of the regulated entities in the sector, the guidelines which have come from, say, 21st of March are applicable to the regulated entities, but they will get extended to the non-regulated as well. So the second part is like code of conduct. And as Naveen said and Mr. Bansal said that the data is going to be the most important part. And The third part is like say that what usually all of us as citizens and as ordinary individuals operating in the society feel is that we will never be caught. Right, it's only a matter of time. Right, the camera may not capture me today at this signal. I'm just giving the usual things which will happen. But somewhere if I'm on the wrong side, I'll be caught. Time could be of essence if it's an early warning signal, and the SROs have a very positive role in the inputs to be provided for policy making and also the resolution part of it. So we have to be an ally of the regulator, in this case the banking regulator, but in any field, in any case, whether it's going to be SEBI, IRDA, or TRI or anyone, and all of them are going to be on the other side. And as entities, we will be always saying that yes, we have been able to establish ourselves, we have a code of conduct, we have the early warning signals, we are having the membership which is committed to being self-regulated. And then that will have to be shown, demonstrated. One is, okay, we have the code of conduct, we say this is the code of conduct running into 5 pages or 50 pages or 20 pages, fine. Second part is like say we have the discipline, everybody has come in, they have contributed, it is fair, transparent, completely non-discriminate in terms of the pricing, membership fees and all. We have an independent board, doable. If we decide, doable. Whether we'll be able to have the early warning signal and convey it to the regulator, lot of internal mechanisms will start operating. I am big, I am small, I am medium. This is the first instance of what being done. Ultimately, there is not in black and white, it is in the gray area, whether it will be right to inform the regulator, not inform the regulator, engage with that. And the bigger the industry, now let us try to look at it from the regulator's viewpoint. I'm talking right now only from RBI. Other regulators will also have the same type of challenges, but starting with the banks. You have the banks, you have the public sector, the private sector ownership, then you have the local area banks, the regional rural banks, the payment banks, the small finance banks. Then come to the NBFC, the different types of NBFCs. You have the payment aggregators, you have the ARCs, you have the account aggregators. FinTech, right now, non-regulated, time will tell. In what format the regulation will come or the SROs will work. My guess is as good or as bad as any one of us in the room. And the number is going to expand. It is not going to shrink. So if the sectors which are going to increase for any regulator worldwide are going to expand, the SROs are going to be playing the most important role after the regulator has done its job or will continue to do its job. And that's why if you read between the lines, they say they are going to be an ally. Very rarely a regulator comes and says that I want to have an ally. Because you always feel it's like parting with the part of the regulatory authority which the regulator commands. The difference between any other sector and the regulated entity is that a regulatee always comes forward, applies for a license and gets the license, and if the entity is lucky enough to pass the test of it. As opposed to any other place where we can decide to be just an association of persons. Fine, we decide to exit. And the most important part of it is, under the policy decisions, the non-monetary penalties, RBI is very clear. You can levy any penalty, but it cannot be a monetary penalty. Then what comes to the power of the SRO is moral suasion. Easiest thing to be said, most difficult to be understood, and still more difficult to be implemented. बोले आपने तो वार्निंग दी थी, प्यार से बताया था, तो हम लोग कर लेंगे, मतलब we'll take its own time. You see, like say, you nudged us. That's the usual way, na? Like say, okay. Then immediately you are telling one, the warning signal goes to all the members. So the independent director, chairperson, or the independent directors are going to be at least 1/3, which implies 2/3 are going to be the industry practitioners. And they are the ones who are going to say, let's play soft pedal karo, kyun abhi danda maar rahe ho? Aapne bata diya, it's good enough. Now look at the risk involved in that. And that is what I'm trying to say. You might feel that I am trying to be going slightly overboard and pressing the pedal on the regulation too much. You and I, as an SRO, don't go and tell and share the early warning signal. There is a fourth estate, there is a common man, there is a person who will be impacted, there is a customer and a stakeholder who will be outside the SRO and waiting whether the SRO has reported to the regulator or not. You do it. The best part of it is the regulator does, yes. You also tell it's great. But if it is known from someone else and then you keep on remaining mum, I think the credibility of the SRO for the purpose for which they are being established starts taking a beating. That's the most important part of it. Friends, we will have to bring in the credibility. Credibility will lead to the constant interaction, the policies which are there in existence or which will be coming in future. So the policy inputs which the SRO can provide and where you can have the advantage of the entire industry body, bringing in the inputs and saying these are feasible, these are desirable and these are the immediate concerns, and that is where the entire environment, not only in the country but worldwide, is there with an integrated one. I just stop here, but I feel these are the important things in which the regulator is liking the SRO's sector to grow, whether each sector will have one, subsectors will have their own SROs, some sectors may take their own time. One thing which maybe in the next question might be coming is the recognition from the regulator. To have the recognition part of it will take its own time, but I think from day one we have to be prepared for that. And the most onerous clause in that is the regulator will be at its liberty to conduct the audit, and the audit fee will have to be borne by the SRO. Now, why I'm telling you all this is that this looks very difficult to do, but if we do it, the advantage is that the supervisory cycle which the RBI or the regulator is going to run will be still more difficult than the individual thing which the SROs would be doing with its members, where they are in constant interaction and they form the members of it. Thank you.
We are slightly running out of time actually, so while I am really thrilled to see so much of audience here and would like to continue for a while, but because of the limitations of time, would request the panelists to have their closing remarks, and with 2-3 areas that I would like them to cover actually. One is consumer protection and competition, fair competition. And another third which Mr. Paliwal had flagged, must though that's not a part of this omnibus framework, to ensure financial independence of the SROs, can RBI, this is a thought, this is not contained in the guideline actually, can RBI contribute some initial corpus or a part of recurring expenses to ensure that they are ring-fenced from the influence of the members? So that's one area where I would like your thoughts on.
So I'll briefly touch upon 2 or 3 areas and try and still keep it brief. So one is on the challenge, like Paliwal sir and earlier Bansal sir also said, that the governance is the key here. The whole reason of omnibus guidelines was the governance. And again, I'm just being candid here. When we were discussing even within our association, I always recommended a majority independent director, exactly for the reasons that you were talking. And you'll be surprised nobody was in favor of it. And my reason was exactly this, that there is a reason association is not required to be the SRO itself. They're supposed to be sponsors. And the moment you have, let's say, not majority, but only 1/3 independent, you'll always have that challenge. However, it also has certain challenges because within the guidelines, there's some funny language used by RBI which doesn't adopt the independent director definition as is of the Companies Act, but others say that you should have independent person not associated actively with any fintech. Then what kind of expert will you get? If he's not associated with any fintech, if he doesn't understand the sector, then what kind of an independent director you would get? So anyway, these are just quick flavors on a financial independence. I think at least some of the learning we had, and we agree with you that it needs to be independent. But it doesn't have to be from RBI, at least from a fintech perspective, we don't see that as a challenge. The funding or availability of a resources is not as much as a challenge, but delinking the money contribution and the rights. So the principle of one member, one vote, irrespective of the size, but you probably have a separate mechanism of charging financially based on their size. But don't link it to the voting road. So for an example, we had done it by guarantee. So it does this, just one member has one vote for an example. It doesn't allow them just because they have a higher equity, higher voting power. So that's how there is a solution available. I don't think RBI corpus, at least for our sector, has been kind of a need. That wasn't required. I don't know about others. So those were the two QQ, which was the third. I think I'll stop here since the time is this. We'll rather take audience question. Consumer protection, sir, I think we all know that's a key reason and we all understand. And also a lot of action happens on the entities because of that. So obviously the code of conduct, everything that we talk about is mainly for that. So I think it's given that is the most critical area we all have to work and probably the first one to start. Sir, I think it's a fair market play. The regulation already exists and SRO doesn't get to make new regulations, right? It's within the existing regulatory framework, you can do clarification. So I think that piece currently is handled by the regulator very well. It's a fairly balanced. And if there is a not level, obviously it gets settled in some period of time.
एक बीच में क्वेश्चन
I think,
आपको होने के बाद क्वेश्चन थोड़ा
I don't think I have anything more to add, but as Naveen said, customer, if we talk of consumer satisfaction or consumer issues, I think RBI is already quite heavy in that area. And SROs, I don't think they can add to that. And if there is some fault at some entity level, so that in any case it becomes either a complaint issue or grievance issues with RBI or the regulator. SROs perhaps will have a limited role there. Maximum it can advise the member to follow, which anyway there is a code of conduct, there are guidelines, consumer protection guidelines. So that may not help much. It's not required rather. RBI funding, I doubt, because first of all RBI will not do such thing. Secondly, then it becomes virtually a regulator. So I think it should be self-funded only. That's my view. Thank you.
On the consumer protection, I feel that it is a requirement. Industry always feels they are doing the best. It's when you wear on the other side of the shoe, then you know where it pinches. You go to any sector, the entities feel we are doing the best. You see, why do we require anything? Now you go on the other side of the thing and ask for the same thing and how much time you get, how much time it takes to if you have a complaint. And first and foremost is that goes back to when I was in RBI and handled this consumer education and protection and the ombudsman scheme. The
two quick points. So just two quick point on, one was on the word voluntary membership. So it's seen, so it sounds like a good practice, but if only regulated entities need to be part of the SRO, they believe, especially the larger the entity is, that we already have access to regulators. So why do we need SRO as one more, let's say, step in between us and them? Would it increase our compliance? Will it increase the work? I mean, this is again basis the discussions within the industries. We see a lot more resistance. And somewhere we understand that while RBI says voluntary is never voluntary, it's always compulsory. So at some stage that clarity will come. My belief is the word voluntary should be only for which SRO to join, not SRO to be joined as a voluntary. The last one is, if there are multiple SROs, how do you handle issues between different guidance by two different SROs? Who does the dispute and resolution between those two guidelines? Maybe Paliwal sir will have some views on this because MFIN and Sadhana are already there. At least I have heard about one or two occasions where they had been challenged.
ये नवीन का पॉइंट वेरी इंपॉर्टेंट है. Either
That
आप
is
करो,
not covered
नहीं
in
तो
the
आप
guidelines there.
आएंगे.
Yeah.
वो भी इंपॉर्टेंट है. करेक्ट.
So those two quick things I thought I'll just say.
या यस सर, आप पूछेंगे भाई. या one or two questions now. Yeah, who are intelligent to ask on the SRO? Come on. Yes sir. अर्चित बासु. ये माइक देना भाई. माइक. Yes sir, he will hearing sir. Yes sir. Arjit Basu is our ex-chairman of banking committee and ex-MD of State Bank of India.
So
Yeah.
firstly, very well put, and I got a sense I was actually not very clear till now, and thanks to the panel for giving a very clear. I think Mr. Paliwal put it very well, and so did all the others. My question, interestingly, is not to the panel. So these draft guidelines have come about, 6 months back? And it's still at the draft
Yes, sir,
stage.
ये draft नहीं sir.
ये final है.
ये final.
It's come out final.
ये final है.
Yeah.
और so thinking that fintech or some other sector wise आएगा.
Sector-wise will come. So I am excluding fintech from my question and addressing it to the one sector which I understand the best, which is banks. And if NBFC is present, the same question goes for them. These guidelines have now come, whatever, I think 6 months back or... and we have Madhav Nair from IBA, who is the secretary of the IBA, and we have a very senior CEO, who is also part of the IBA, who I can see straight opposite me, Mr. Singh. What is there must have been some thinking on whether you want this or not. Are you in a position to say whether, two questions on that. One is there a thinking that this is at all useful and you are planning to set it up? And B is, these have been discussed. Given the difficulties, I think Naveen pointed it out at the last instance, that all the complications which could arise if SROs were to be set up, would SROs in the present avatar as given by RBI, are banks comfortable with at all coming up with it? This was my question.
Sir,
Yeah.
of course they will answer. IBA as such is already an implied SRO. In a way, both the regulator.
No, then I go back to Mr. Paliwal. He was very clear that an industry body cannot be an SRO.
Yeah,
And RBI has also said in this circular very clearly that there has to be a separate application made. So is there any thinking? We can hear Mr. Nair.
I understand clearly, there was a meeting in IBA.
Many years back, and very clearly, if you notice, BT advisories to back, we don't issue guidelines to something for them. So the conscious decision of IBA so far has been to not be an SRO. So that's a position. But yes, to the second part of it, we are evaluating not as IBA, but maybe as some other form. So those discussions are happening.
So like FIMDA would be a SRO, right?
FEDI would be.
FIMDA and FEDI are SRO. FIMDA and FEDI are SROs.
or deemed SROs.
Are deemed SROs, yeah.
That is where there is a speech. The speech by our Rajeshwar Rao addressing the FEDI conference, and that speech, I request all of you to go through the how SRO is required and how that has been evolved and how on the बहुत अच्छा article है. आप recently he covered only on the SRO in that area, and that's why FIDA and FIMDA and all they are because even there he mentioned about the Libor scandal that externally. आप सुना होगा सर? Because may not be a formal guidelines where
They have been SRO.
there were no guidelines as such. There were no guidelines as such, but he has mentioned that they are already there, but he is looking for some more active part from them. So beyond that now, Pooja or anybody as a, आपका किधर? Malhotra ji, माइक दे दी.
They tend to become self-preservation organizations over a period of time. There are experiences, you look at Bar Council of India, Medical Council of India, whatever Council of India, they are self-preservation organizations. They become over a period of, they tend to become.
Yeah.
What kind of checks and balances we are putting into these guidelines that they don't tread that path?
Anybody answering? Aye.
I think it's a very good query which will be done for the regulated entities. Since the SRO guidelines have come only for the regulated entities, I am saying that's there. But I represent an organization for the currency where it's non-regulated other than the banks. And we have been in constant interaction with the RBI, including the COVID period when the regulated entities were finding it difficult to share the data, and we were sharing it on a daily basis, right up to the Prime Minister's office and including the RBI. And after 6.5 months, they realized, and rightly so, the Honorable Prime Minister said that, okay, the data is coming on a daily basis. So the thing is that we have to have the intent and the credibility. It's a painful process, I'm saying initially. But then the yield is so much. And then the distinction between what you said of the self-preservation or the purpose for which it is meant, and going forward, possibly you will find both. It's too difficult to say right now, but the ones which will succeed are the ones which will be following the practice for which and the intent for which they have been established. Others, the Darwinian law will apply, you see.
I will add just one line. The concern is very, very big because if you see, because of this degeneration of industry, LIBOR has now got a natural tail. This can happen if the industry doesn't adhere to best practice. LIBOR is a LIBOR.
We are a little particular about timing, but आपने हाथ रहे थे एक क्वेश्चन आपका है उसके बाद हमारा बिकॉज इधर स्टार्ट किए हैं बताइए. हाँ. Yes. Oh. Yes. Very good. And all our speakers are available even after another 1 hour after the program. They are available. Some of you should meet all of them. They are very influential and also good opinion makers. So with that and thank you Harihar ji. बहुत अच्छा किया. आप सबको एक Now I will pass on the next stage of the discussion to PD Singh, who is the CEO of JP Morgan and very knowledgeable, as well as he rightly said, Basu Sahab, in IBA, in all organizations, and he is going to take on climate related disclosure and the preparedness of the bank. Yes. Mike.
So, firstly, good evening to all of you. We are lucky this evening to have. It's not working.
You can go ahead.
Yeah, I can go ahead. We're really lucky this evening to have senior folks in this room. We're actually privileged to have very senior bankers. who heard who all is in the room today. We also have members of our committee, immediate past president as well, Mr. Basu. We have Sandeep from Citibank. We have Madhav Nair, who is also the CEO of a bank. We have a very powerful panel today, and a lot of the discussions that happen in this room today, and I'd encourage all of you to participate as well, would form the basis of our recommendations from IMC to the RBI on the draft guidelines, and we have time till the end of next month to actually make that recommendation to the Reserve Bank of India. So firstly, the context was very nicely set by Mr. Narendra and our President, Mr. Somaya, as to what the guidelines are about and the framework that has come in. So it's very aptly timed. Our discussion is very aptly timed. The regulator has taken this step, which is one step closer to transparency and making sure that the enhanced climate diligence is taken care of by the banks. So as a background, and I won't repeat what's already been said on physical risks and transition risk, but there are 4 key themes that are contained in this. The good news is that this is in line with the Task Force on the Climate-Related Finance Disclosures, which is the TCFD framework. So it is broadly in line with the global frameworks. Yeah, and that's why getting alignment with all global frameworks will be very critical, so that we are taken seriously in the global context as well. We're very lucky that we have the 3 panelists that we do, and I will introduce them just after giving very brief thematic areas that the draft circular covers. So firstly, it covers governance, then it covers strategy, covers risk management, metrics and targets. Lastly, I think very important from different other sources to understand what is the rationale to have this, why do we have to have these disclosures. Like I mentioned earlier, one is it is for transparency, and that's the only way you can have a sustainable economy. The second is to foster the early assessment. So before it's too late, we do need to have these opportunities and the risks clearly quantified. So if then we take a path the other way, we are doing it consciously knowing what we're doing. And facilitating market discipline. So you cannot constantly be truant or on the other side and do something that the market is not going to favor. There is a fear of growing mispricing of assets, misallocation of resources, and therefore again this framework sort of provides us a way forward on what banks can do. So let me first introduce our panelists and then ask them questions, hand over to them. I'll start with you, Hina. You're one of the senior partners at EY. You are the subject matter expert who's actually probably in this room got the most amount of years of experience on this topic. And you lead the financial services sector within the climate change and sustainability services of EY. You've also had international exposure, so it'll be very exciting to hear that part as well. We're very lucky to have with us Sajal Kishore. Sajal has come all the way from Singapore, so thanks Sajal for being here, and I know you had another commitment which you gave up to be with us this evening. So priority to IMC, and that's really nice to see. Sajal is the managing director at Fitch. He's based in Singapore. He's worked in different parts of the world, including in Sydney. He's currently the head Asia Pacific Infrastructure and Project Finance for ratings. So again, very exciting for us to see the international perspective that you will bring in this discussion. Jitesh, thank you for being with us. Jitesh is the CEO and founder of a SaaS company. I think many of us have heard of it, but he will explain exactly what he does. So Credible is been headquartered in the US and has offices in different parts of the world, including in India. Prior to Credible, he's a serial entrepreneur and has earlier established Quick Labs, which he sold to Google, was it? And then you helped scale it up within Google. So very experienced, if I can use the colloquial word, techie. So you'll help us understand the tech aspect that we need to think through on this space as a bank. So without ado, let me first shoot my first question to you, Hina. Let's set the context. Why is it that it is critical for a bank to have a role
Right.
in the current scenario that we're talking about.
Yeah.
So
Thank
please,
you. Thank you, Mr. Singh, Mr. Narendra, for having me today. Frankly, if you ask me, it's not because of the experience I've had, but financial services as a sector plays, in fact, the most important role in the world's transition towards net zero, towards carbon neutrality, whatever we want to call it, right? Basically a low carbon economy. Why? Because while there are certain sectors that have been identified, that are responsible for the most emissions that go into the atmosphere, and these sectors could be anything from mobility and transportation to mining to whatever we say, sectors where the emissions are very high or the consumption of energy is high. Financial services is a sector where everybody, most banks and NBFCs and everybody we talk to say, our emissions are not even high. We are a professional services organization. The only thing we use is electricity and in our branches and in our offices, and that's really it, right? That's fair. But it's not about what are your emissions as an organization, it's about who you're financing. If it wasn't for a bank or an NBFC saying, the transition of the world really depends on who the banks and the FIs are willing to finance and not willing to finance. Frankly, what's been happening at the global stage is certainly the movement in the financial services started a long time ago, but it's been formalized to some extent a few years ago with the Net Zero Banking Alliance that was formed, or there's a larger alliance called Glasgow Financial Alliance for Net Zero. GFANZ is a body that was set up, I believe, 2 years ago across banks, insurance, asset managers, asset owners, all of them. 600 larger institutions have committed to reducing their emissions, and not just their own emissions, so there are 3 parts of emissions, scope 1, 2, and 3. 1 and 2 are your internal emissions, basically your electricity, the fuel you're consuming in your cars and all of that. 3 is your indirect emissions, and for a bank, the indirect emissions, the highest is the investments that you're making, or any FI, frankly. If we look at it, most of the emissions will come from the wholesale and the corporate or the institutional book. Very little, or not, I wouldn't say very little, but a smaller portion of the emissions come from the retail book. So even the banks globally, to set the context, there are more than 600 organizations at the global level who said we will go net zero by 2050. India's net zero target is 2070. Now, the truth is GFANZ or the Net Zero Banking Alliance currently doesn't have any Indian bank or any Indian financial institution. I think that's, to be very honest, I can say that India has, specifically the financial services sector in India, has been in some form taking it slow to see what's happening globally. And globally, to be very honest, for a financial services institution, transition is a very difficult process. And last 2 years, we've seen this happen time and again, where companies signed up to be a part of Net Zero Banking Alliance, 1 or 2 companies dropped off, and there's a lot of, hue and cry in the media saying, this is not working, ESG is farce and all of that. And we know there's a political angle to all of this, right? But leaving the politics and everything aside, the crucial element for a financial institution and why they should consider this, or why they are considering, is 1, climate change is already affecting some of the lending portfolio or some of the books for banks. That could be from extreme weather events. That could be from changes in technology that's happening so fast in some of the sectors that if your key clients don't keep up with that technology, they will lose out, and which will impact the returns that you may be getting. It's also, frankly, forget about the risk. I know RBI is talking about the risk, but most organizations who are bullish about climate change, they're not doing it for the risk. They're doing it for the opportunity. In India, there's a 10.5 trillion funding gap for us to go net zero. And the government's constantly pressurizing or trying both the domestic as well as international institutions to start putting their money in sectors that are climate positive, in products that are climate positive, right? I mean, 10 trillion cannot be met without the Indian domestic funds being able to open their books and really transform their lending strategy. And even the international institutions, we certainly need a lot of foreign money also coming in. So the most important is this is a 10.5 trillion opportunity if you look at it. It's just a matter of how do we transition, because India also has to balance its development requirements. And specifically for banks, I think the most important question we get is, if I don't fund this company because it's not, it's polluting or basically its emissions are high, somebody else will. And why should I lose out on the business? And that's a fair question. There is a strategy on how do you go green as an FI without going red in your bottom line. So we just have to develop that strategy that suits best for each financial institution based on their portfolio mix. And honestly, most of the global banks who've set out on this and who've taken the strategy are focusing more on the corporate and the wholesale book. I think retail, there's only so much we can do. So there's still, frankly, a lot of global research happening on the retail side, but at least on where the emissions are the highest, most banks have started focusing on it. Globally, in India, thanks to RBI's regulation, maybe we'll see that happening in the coming years. Yeah.
No, thanks for bringing that out. In fact, I always say we have, our disruption is driven by the regulator. So we have a very innovative regulator, forward-looking regulator. And if, in fact, the RBI did nothing, banks would just not move, right? So the regulators forcing us to think about.
I think a regulator knows that too. Yeah.
So for example, the physical risks, and just to bring it to life, so the physical risks could be climate change. We spoke about how the agriculture sector may be impacted, rising sea levels. We live in a coastal city. We don't know how that is going to impact the banks, the assets that they take as security. The loss of ecosystem, which itself could be a very important part. So there's a lot. You see the extreme weather events happening, and how banks may suffer if they have lent to, say, Dubai airport, maybe, right? So there is a lot that in climate risk that banks have to think about. But let me come to you, Sajal, as an international rating agency. How do you look at the current risks, and how are they assessed, especially in the context of all of this that we're talking about?
Thank you. So as a credit rating agency, we sort of obviously get involved with companies which are tapping the offshore capital markets. I operate in the space of infrastructure and project finance ratings, which is essentially companies are looking at they have long-term assets, and therefore they're looking at more longer-term money. And that's quite different from a corporate entity, which typically will do a 3 to 5 year bond. So the time horizons are very different. So, and therefore our rating horizons, when we model and look at creditworthiness of these companies, our modeling is very different. Our time horizons that we look at is very different. And therefore, there is a lot of challenges, especially in the topic that we have on climate risk and climate transition. So what we have at the moment is, as a part of our credit rating, we assess ESG scores. And the ESG factors that's relevant in explaining or having an impact on credit ratings is what we currently assess, along with many other things. But I think given there's been such a significant focus on ESG in the past few years, that it was important for agencies to come out and explain how ESG was always very much part of the risk drivers and the themes that we assess. And that's something we have been sort of explaining, but it doesn't explain whether a company is green or dark green, light green, different shade of green. It just explains how, in the industry that they operate, how exposed they could or could not be. So that's typically what we have at the moment. But we're conscious of the fact that climate risk is something which is clearly upon us. There's global warming happening. And therefore, as an agency, we've been looking at how do we look at climate risks, which is more longer term, so much more longer term thing. So last year, our corporate finance group. So as I said, I'm part of the infrastructure finance group, but our corporate finance group, which looks at really companies, and their rating horizons are 3 to 5 years. So they have come out with a climate vulnerability scores, and essentially the climate vulnerability scores, and that has been assigned to each and every entity which has sought a credit rating. That essentially looks at more transition risks, not the physical risk. And the reason why that is, as I'll sort of touch on, is, the physical risk is more on the infrastructure assets rather than on the companies, but the companies are generally more exposed to transition risks. And that's also because the transition risks are more sort of near to medium term, and that's driven by different policy or regulatory response that is being undertaken in response to global warming. And again, our framework that we have devised is based again on the same UN principles for responsible investment, and all the policies that have been set under it. So what we've done is, for different sectors, we've set up our own baseline up to 2050. What will be the baseline for different industries? And then look at how different entities within that particular sector are exposed or responding to that particular threat. Whereas on the infrastructure side, there is the risk of both physical risk as well as the transition risk. And the physical risks, as PD just mentioned about various weather events impacting, that's a bit more medium to long-term impact. Now, that is still an evolving area. Companies are still not really out there. There's different stages of evolution of how companies are thinking about it. So therefore, our own response is muted at the moment, but we are in discussions with companies, asking them, like, for example, if I rate a port company, I will always ask, rising water levels, how will that impact your port operations in the future? And what are you doing about it? How are you thinking about it? How are you going to protect yourself about it? So this kind of questions is something we're starting to ask, and something we will assess going forward. But it is an area which is evolving clearly, and there's a lot more needs to be done in that space. So I'll stop here for now.
Yeah. No, thanks, Ajay. Very insightful. Coming to the transitional risk, and that's where probably technology comes in. Not only how customer preferences may change, technology itself might change the business completely, but how can we use technology as well for the monitoring of this aspect, as well as the growth of the bank in a more meaningful manner, even in the Indian context?
Yeah, thank you, Mr. Singh. So where Hina left, right? So when you think about decarbonization, there are three kind of categories: scope 1, scope 2, scope 3. So internally we call it the 3 Bs. Scope 1 is what you burn. So let's say as a company you're burning diesel. Scope 2 is what you buy. So you're buying electricity, and scope 3 is beyond. So now what ends up happening is scope 3 is the most complex to measure, right? So for bank, it's all scope 3. So that is very, very hard to measure. So there, technology has to play a very, very critical role, right? So what that role is, it's a data problem. How do you solve that at scale to make sure that data is complete and also accurate? Right, that's one. That has to be done. It can only be solved by technology. Second is where is the opportunity for banks? And I think the opportunity is to invest in the right areas where these technologies that will create value and businesses built around that, identifying them, right? That's the second thing. Third, when you think about products like green bonds, I think technology can play a very good role in traceability. That are you really deploying that capital in the right space that you said? For example, one thing we explored, which we have not done yet, is can you use blockchain, for example,
to track a project which is funded by a green bond, right? So that when you're continuously assessing it, that the capital was used for the right project and measure its scope 1, scope 2, scope 3, you can do that in a very automated way with very little operational overhead. So I think there's a lot of opportunity, primarily because it's a huge data problem.
Great, thank you. Sure.
Our president has another appointment, and please give him a big hand.
Don't give me a big hand. Excuse my absence. I have.
You are our inspiration. Yes, thank you.
Sorry, sir.
Please continue.
No, thanks. I think that's a very interesting perspective that you provided on how, and the biggest problem that we have, in fact, in front of me, I have an Observer Research Foundation a note which is also analyzing the same circular, and somewhere at the end it says unless the borrowers disclose meaningfully and verifiable and timely information on the greenhouse gas emissions, how can a financial institution even begin to do the assessment, right? Because they are being measured by what their client is doing with the money. So that is a very important aspect that you bring up, and it's actually being discussed, which is something that will really help going forward. But carrying on with that theme, Hina, how do you think that, or what are the kind of help that you think financial institutions will actually need in this journey, given that it's just begun?
Yeah.
And there's a lot of expertise required.
Absolutely.
To actually demonstrate their ability
Correct.
to make a meaningful impact.
Frankly, I think what RBI has recommended through this, so I think there's an opportunity here, or rather to learn from the global journey. I think in India, this regulation is still not finalized. It hopefully will be towards the end of this year. RBI hasn't mandated it yet. It's still in the draft stage. But with that being said, the larger global banks, or the rest of the world, has been doing climate risk for almost 8 or 9 years now. So there is a lot that the Indian banks can learn from the global banks' journeys, not necessarily go through the same path of complications and challenges, and there's enough that's been done. So the idea is, how do we leapfrog and get started on our journey here, right? 2-3 major issues, and we're currently doing climate risk assessments with a few clients in India, and the most important challenge we get, to what Jitesh pointed out, is data. You will need data for example, in your corporate loan book, there are 2 kinds of data, right? One for the physical risk. If we have to assess the physical risk of your book, we will need the zip code of the major offices or major facilities. If it's a manufacturing, say for example, if you're giving a loan to a manufacturing company and they have like 3 plants, and so we'll need the physical zip codes of each of those plants, so that when we run through the scenario analysis and the model and the scenario modeling, basically, we will know if any of those are in areas which may be exposed to physical risks. And that could be flood, that could be earthquake, that could be drought, whatever it is, right? So that's one piece. On the transition risk is where transition risk is primarily for the high emission sectors. Like for example, let's just go with the steel sector. The steel sector is already exposed to a transition risk of carbon tax, not in India, but in Europe. There's the steel carbon tax. So there's a regulation in Europe, in EU, called Carbon Border Adjustment Mechanism, which they've put in place, and any company that is in the high emission sector and is exporting basically from India, or importing, if they are importing something, there has to be a tax on how much emissions were used to produce that product. So all the major steel giants in India are now starting to invest in transition and decarbonization, because they know that if they don't do that, they will not be able to export to some of these markets anymore, because their products will be more expensive compared to the local products. So this is a transition risk that we're already seeing. So when you start, I think the idea is every single financial institution, needs to start looking at what are the data gaps we have. Let that be from a physical risk perspective, or from a transition risk. For a transition risk, we will need access to the emissions that each company in your portfolio has. Now, this is where the tools and the data comes in, what Jitesh was talking about, because you will not have this information. In India, only the top 1,000 companies, thanks to the BRSR regulation by SEBI, we have some information on their emissions right now. That can be pulled through a data tool or anywhere. But what about the many other companies that don't necessarily have published this information? What about the SME portfolio? I mean, if you tell your SME that, listen, I need your scope 1 and 2, the SME is going to be like, first explain to me what that is, and then get me a consultant who will calculate that for me, because I don't know what that means, right? So there is a learning curve involved. There is technology that can be, frankly, in the first 2 years, most banks use approximate data based on sector, based on location. There are enough data tools and basically data that you can buy off of these data sets, which will tell you approximate, and that's how most of the banks in the world are doing it. So that's, I think, to start with, this is a major gap that we need to address. 2, it will be about the strategy, because RBI is saying in the first 1 year, please talk about the governance that we have, each organization has in place as to how will you manage the climate risk. 2, the strategy specifically, and 2 years later, you will have to talk about the metrics and the targets. That is the major component, which is, I know I have more transition risk in this particular sector. These are my current metrics on it. Basically, this is how much emissions I have, this is how much risk I have. This is my strategy and target to reduce it, or, how will we go about it? So I think we will frankly see a lot of interesting, the sector changes in the next 2-3 years, because every financial services sector company in India will start looking at how do I reduce my emissions in certain sectors, while frankly, it's a just transition. I think I want to just end with this term called just transition, which is, you can't say no to your current clients, but you have to, in fact, it's important to take this as an opportunity, like I said, to help them transition. So you can't tomorrow walk up and say to an oil company or a steel company saying, I can't give you a loan anymore. That's not the idea. In fact, we have to suggest to them that they need to start investing in decarbonizing. And of course, they'll need more funds to invest in energy efficient technologies, to invest in new kind of technologies, right? And that's where the bank has to continue to handhold their clients towards a low carbon economy. And that's the just transition finance, that's the terminology, yeah.
Yes.
I'll just build a little bit more into what you said to bring it to life. In the international scenario, what is exactly being done, like you mentioned, for example, in my bank, we have identified 8 specific industries. Each industry has a particular carbon footprint that our loan book currently has. And there is a target by a certain year, whatever it may be, 2030 or whatever, where we want to be. So there is a priority therefore set out when I am going to give a fresh facility, or when I am going to evaluate whether or not the additional exposure that I take to that sector is in the right direction or not. Like you mentioned in steel. So for example, in India, in steel, unfortunately, we don't have scrap and we cannot do electric arc furnace, so we will do coal-fired plants. But now we can go a step further. Am I financing a port that is only bringing in coal? Am I financing a railway line that is only facilitating movement of coal? If so, is that socially beneficial because it's taking off hundreds of trucks and freeing up the roads for other economically weaker sections? Also, you have to take a very balanced and nuanced view of the whole scenario, and I think that is the
absolutely
the difficult part about this.
And frankly, this is major behavior change in the teams who are assessing the loans, in the risk team. The way the risk team evaluates is going to change. Like for example, climate risk impacts your credit risk, your liquidity risk, and your market risk in every transaction. So if you are investing in a, say, steel company, you're going to have to look at how is this impacting the credit risk of this company, or the liquidity of this company, or the market risk for this company. So I think for the risk teams, this is a transformation.
Question. for individual rating model of the bank also have to undergo change in line with what you are mentioning, no?
Yes.
What do you say?
Yes, absolutely. I
Yeah.
think
That has to be integrated.
So which is what RBI is asking for, that you have to have metrics and targets
Yes.
to show that you are actually serious about this transition.
Madam, yeah.
Otherwise, to rate the borrower that you have on the ESG framework, and then you need to, when you can't differentiate the price, you need to have the record of the rating, which is needed now, in order to decide. on the
Absolutely.
strategy of the
Madam is the Chief Risk Officer of Aditya Birla.
Right.
Yes. So really good.
So we
feedback.
call it a carbon assessment framework. So you can do
Framework.
that for each borrower, and you can then see the transition of the borrower and assign them a score, and your own score gets impacted if you are financing the wrong kind of.
I am just interfering for the gauge of the audience. Which are the some of you who have already implemented or some policies already done and all? Kindly raise your hands. Who are all on the ESG? Yes, madam. If you are, don't worry, raise. Who else? Okay, some of them here. Saab has raised so many others. So you also done, correct? I know you are already on the job. Union Bank. So that is okay. Now you continue.
Yeah, no, I think very interesting. This is a topic where we can go on all night actually.
Yes.
But let me get Sajid's views, Sajal's views on in infrastructure, offshore. Like I gave you an example of how financial institutions are doing it offshore. Are there any best practices that we can learn for, or actually make recommendations as part of this exercise?
Yeah, so I think, as I was saying earlier, that ESG is something which everybody is thinking about, and we have seen the impact of it. Talked about different banks. We saw some banks clearly walk away from coal, right? Some of the European banks took the lead on that, and they stopped funding coal in Asia Pacific. Now, recognizing that coal still plays a very critical role, though a declining role in the power generation over future, but that clearly led to problems for some issuers in different markets, where that pool of funding which was available for them suddenly dried up. And it had an impact on their refinancing ability. And that's where we came in, and it kind of reflected in our ratings as well. So that is clearly an area where different companies are watching it very carefully. But equally, I would say that this area is still very evolving. It's still evolving very as we speak. We saw the impact of Ukraine war, what happened. Gas was meant to be a transition fuel. Before that, some banks were not even willing to lend to gas. Ukraine war happened, energy prices went through the roof, gas came back in favor, and now banks are more than willing to lend to gas. So there is a little bit of a short-termism in this market, but everybody recognizes that climate change and transition risks is a very long-term thing, and that definitely is the way things are panning out. So as I was saying, that different companies are still very early in this stage of their preparedness for climate risk. ESG, yes, but climate risk and how they will look at physical risk, the impact of physical risk. I don't think every company in different regions are still out there. They're still thinking about it. Some are actually starting to actually put some money, reserve some money, or build some protections to protect their assets. But it's very early stage in that sense. And that's the reason why we also, as an agency, we have on physical risks, we have started to, as Hina was mentioning, we have started to actually locate each of these assets, like we rate airports, all renewable assets, just to look at even the impact of weather patterns, how that will impact resource, even renewable, which is a green resource, right? Changing weather patterns are impacting their performance. So I think we're starting to do that, but it's something which will clearly evolve, but it is an area which, on the transition side, there are two things, right? Because one is clearly government policies or regulations which is direct, like a carbon tax or a carbon pricing mechanism, which is a direct intervention, that you have to respond to that. But others is what Jitesh was saying, like technological changes or industrial changes, which is in response to a changing environment. That is a more evolving thing, and issuers will need to be constantly be prepared for that. And how they respond to that sort of a changing environment is something will sort of happen over time.
It's a very important point you make, direct intervention and a nudge, which is also required to drive right behavior. I think a lot of these would be case studies for other industries to learn from. And a very interesting point you make, just because it's renewable doesn't mean climate risk will not impact you. If the wind pattern changes or if there is too much rain, the solar farms may be not of any use, right? Or battery may,
Battery
yeah.
remediation costs.
Yeah.
Not many people are thinking about that at this stage.
Sure.
So those costs also going up.
Jitesh, there is many things and many challenges that financial institutions will face. Some of these are to do with stress tests and doing simulations. Anything that you can share from your experience on this?
Yeah, we're working with a lot of banks and FIs. So a lot of challenges, right? One is talent. I think talent in this space is very limited, and it has to be cross-functional. You need to know climate science, risk, data, you need to be operational. So that's one challenge we are very clearly seeing. Second is there is very little historic data when it comes to scenario analysis, right? Scenario analysis can be done well when you need a lot of historic data. So the historic data is very limited. The third is, these models, they are finally built on some level of hypothesis, and they need to be constantly updated, changed. So that has not been established yet, right? From a software standpoint, is there a way to an established methodology where these models can be changed in near real time? That's a third challenge we are seeing across the board. Fourth, I think a downside of this space being too evolving, right? There are new terms, new kind of frameworks coming in that leads to a lot of confusion. For example, even CBAM, what Hina mentioned, is a very big deal. It has definitely shaken the Indian market, right? Cement, steel manufacturers, where your process emission is very high, but almost they don't know what it is. They don't know who to go and ask for help. And that same thing we see even on the banks in the FI side, right? Because there are so many new things, so many new associations, industry-specific things, there's a lot of confusion there. And stress testing, when it comes to risk for ESG, honestly has not been done at scale anywhere, right? So everyone is going with some assumptions. Like Union Bank is clearly a leader, right? They're way ahead of the curve. If you look at their RFP, it's very well thought through, very comprehensive. But again, it's almost a unique system they are envisioning, right? So that tells you, right? Everyone is really thinking fresh off the shelf, right? They're thinking, which will come with some risks, right? Those assumptions could be wrong. So you need to be agile to course correct very quickly, not really make huge capex upfront investment and tie in, right? But be a lot more agile. Those are some of the challenges, right? It's an evolving space, what Sajjal is saying, right? Which there has to be some solution to that. Meaning, either internal build a team whose job is just to educate everyone, constantly educate, right? And say, come to us if you hear something new, don't trust anything you read on the web, but let us be the gatekeepers of information almost, right?
So very interesting to see that there's going to be an opportunity to develop internal talent and internal knowledge for each institution, in fact. And then, of course, to share. In fact, just before this, I was discussing with Sandeep, a very senior banker from Citibank, and he was talking about ASIFMA. I was just going through some papers, and ASIFMA is actually making some of the recommendations to the regulator on this draft circular, where one of the key recommendations is for standardization and looking at all the global standards so that we are able to be uniform with the rest of the world, especially for Indian corporations that work in many countries. For example, just the Birla Group operates only 29% of their revenues come from India, the rest of it comes from overseas. Many other Indian conglomerates have very large businesses offshore. So they need to be able to report it in a manner that is well understood by all stakeholders. So let me stop there. Like I said, it's a very interesting
एक क्वेश्चन
topic.
है इधर अभी एनेक्शर में एनेक्शर 1 अपने आरबीआई सर्कुलर उसमें बेसलाइन डिस्क्लोजर एनहांस्ड डिस्क्लोजर so in governance in every area so how are we prepared for baseline and इसमें on the quantitative and qualitative aspect दोनों covered so आपका technology में or on our as a consultant also or as a rating agency also because you are also doing the rating of the financial institution also. तो हमारा Indian context में the Reserve Bank has given a very extensive thing. Now the question is because I think according to the deadline this year itself they have to start all that. Of course, reporting per se quite a lot of them have done, but here it is a disclosure which is a very relevant for the all the stakeholders. तो ये एरिया में थोड़ा मेरे लिए आपका रिप्लाई जरूरी है.
Frankly, I think RBI is trying to, one, I think it's a nudge. FY26 is the first set of disclosures that need to happen. And most Indian banks, I think a few have started the journey, but to be able to, it's still not as, I would say, impossible a scenario, frankly speaking, because FY26 we primarily have to talk about governance, strategy and risk management, which is putting the processes in place. Thanks to BRSR, I think most companies have started looking at putting ESG as a committee at the board level. So a certain amount of, I would say many organizations have the governance piece covered to some extent. The risk management and the strategy is where it needs to be thought through. And the risk management and strategy pieces are also where a baseline would be assessing where you stand, frankly. But the metrics and targets is where the real strategy conversation needs to be had, right? And that is 2 years later. But what RBI has suggested is that as first you measure where you stand right now. So you definitely need to have a baseline of what are the risks that you're exposed to, both on the physical and transition side, and then start disclosing on it. Come up with a governance framework. Come up with a risk management framework, look at how it needs to be integrated into the existing risk management processes and framework at the beginning level to start with, as well as an overall strategy. Like frankly, and the best part is that Indian FIs can always just look at a global FI because this has been done. So I believe, correct. There's a benchmark, there's a learning curve. Correct. Yeah. Of course, we can bring that. Yeah. I think, what I would highly recommend is every single organization, most of the TCFD reports are public documents. So just one good read of some of those will already tell that this is not as complicated as it sounds. Yes, it is complicated. We shouldn't underestimate that. But let's start with a positive note that at least we can take care of some of these things. Yeah.
So, Abhi Jitesh ji, just for I'm taking, there are certain risk, physical risk, and that could be done through the client-wise top. There can be through portfolio basis. So particularly Ajay Thakur Sahab is representing SMEs. So SME madam also mentioned, and corporates are also looking for SME getting complied with the climate risk. So that for the international and domestic also it will come. What आपने Europe में बोला, our Indian government also trying to match them, because it otherwise will be a disadvantage for our SME for exports. So, आपका supply chain में you are there. So how are you getting the technology in terms of some of your corporate, more than 100 corporate, they have the SME also. So how are you doing that, and which can be implemented for the banking fraternity?
Yeah, I think it's a great question, right? So 80% of our customer base is in India out of the 100 plus customers. Across those 80 plus Indian customers, we have 15,000 plus SMEs. Now, what has happened, BRSR has been an amazing thing. If you look at even global standards, right, you know how quickly the top 1,000 companies in India adopted that. They said we have to provide some reporting, and as part of that, their SMEs, they have started collecting some supply chain data. So they have been sensitized that, you know, what is this, what is scope 1, what is scope 2, what is scope 3. And some of the rating agencies, those ratings directly get impacted if you don't have visibility into your supply chain. When you think about like the DJSI score of a large company, like let's say a Tata Group company, if they don't have visibility into their supply chain, the DJSI score will take a hit. So that has forced these large corporates to get visibility into the supply chain, start sensitizing them, educating them, training them, making it part of their onboarding, for example, putting some terms in the PO almost, right? That if you don't provide us some of this ESG data, we will maybe next year not work with you. What we have done on the technology side for supply chain assessment, honestly, have changed the game fully. So we are the only company that deeply uses what's called GenAI, right? And we have a capability, we call it the magic drive. So an SME logs in, they onboard, all they do is drop a bunch of documents into the credible magic drive, and it will start auto-filling some of the responses. And then it will tell you, just come here and double check. Right? The biggest problem for SMEs is education, right? They will know that we have some of these documents here. We will have a health, let's say there's a policy required for governance. We have that here, but we don't know how to fill this. So that is something we are solving. The interface on how you provide this data, making it dramatically easy through technology, right?
Thank you.
If I can just give one example of this, right?
Yeah.
So there are two very large global tire companies which have established supply chain programs where every supplier gets a ESG rating by EcoVadis, and based on that they give them a financial incentive. So every time their rating improves, the anchor client, that is the tire company, gives their supplier a financial incentive, as in gives them a better price.
Because the corporates, particularly like suppose Maruti Udyog, whichever corporates supplying to Maruti Udyog, there is a inherent support system. If that is there, that will enable SME to get in touch. So you have some questions? Yeah, she is the expert on the ESG. Mic de do bhai. Alag mic nahi hai. Yeah, please.
How ready are the banks in terms of, upskilling the existing manpower, plus in terms of technology adoption? My second question is like on to Jitesh. You spoke about data, but there is a lot of greenwashing happening. We all know about it. So how are you going to segregate or get the transparency when it comes to data? So, yeah, first question is to Mr. Singh.
Thank you. Also, it's not actually a question, it is for Mr. Sejalji and to the rest of the panel, that you all are talking about something that has not yet happened and how you can understand climate risk. Today, my company, we are doing 3 cities, Zurich, Basel and Tallinn, 24/7, 365. We zoom down from 300 square kilometer to 10 meters square, and I can tell you what can happen now to 50 years into the future, be it atmospheric, geological, cosmic, or anything. Bring in our DRRD tool, which can tell you, as the principles of engineering, what can be the loss. DAX has hired us. I cannot take name of the companies which we are doing it for.
Lombardy, the whole area. We are doing it for insurance, that what can be built for the future, how to build, whether that should be a farmland or a business park, because if you can tell what disasters can happen, you can do it. And then we are stopping the maladaptations by entering the ESG tool within it.
Through satellite also you can get.
We have our own satellites,
Yes, yes.
Switzerland and Copenhagen are our partners.
And some countries have taken the lead in that. Yes, sir.
No, this was an excellent panel discussion. I wanted some thoughts on, see, the current situation is that in India we have the BRSR from SEBI, and now we have the climate-related financial risk draft guidelines from RBI, which are likely to become guidelines as it happens, and it's not too far away. So the 3 pillars will happen next year, governance. So my question is around governance, and I think you alluded to it. So when RBI talks of climate-related financial risk, from a board governance point of view, where should it sit? Should it sit in the risk management committee? That's my first question. Second, the rest of the world is way ahead on ESG, and Indian financial institutions are also slowly now putting in ESG committees in the board, right? So once the RBI thing comes in, even for companies who are doing well on BRSR reporting, that's slightly different from what RBI is looking at. If you look at the entire circular, it is around risk mitigation. So where should it come? Question number 1, risk management committee or the ESG committee? Second, if it comes under risk management committee, then how does the ESG committee deal with the RBI circular in relation to banks and FIs? Just your thought. There is no right or wrong answer to this, but actually we are debating that for some of my firms. So, I wanted your thoughts.
Yes, sir. First question आप बताइए. मैडम ने पूछा है ना. सिंह का, अच्छा सिंह साहब के लिए.
I'll pass it to.
आप yes, आपने क्या बताया था? बैंक का है ना? Banks. हमारा माधव नायर भी है. Yeah, you can.
Yeah, no, like I said, I think they have to develop centers of excellence. They don't have it, and there is no expert available that you can hire. They already all hired, right? So you have to develop this expertise in-house. There's no choice. And banks have to invest in it, so they have to develop in-house. For example,
I would suggest even at the board level, we have to have a orientation for that. And in a futuristically, when they are selecting independent or any director, there should be either on the executive header or on the independent, there should be one who is expert in ESG also or climate risk. That becomes a necessity because current board per se, वही एरिया में आप पूछा तो इतना नॉलेज तो पहले रिस्क मैनेजमेंट कैसा था और आल्को कैसा आया वो टाइम में then slowly they built up. So similarly this either through our own orientation and giving them more and more information because they have to strategize and the middle management has to take the responsibility. So yeah. अभी वो पहले का क्वेश्चन
same question आपका in continuation of that.
Yeah.
See, regarding the skill building in ESG, recently I got, let me introduce, I am Indranil Ghosh, I am basically a trainer, corporate trainer, and ESG is one of my field. I have recently conducted one program and Mazagon Dock Limited, and in that company, all the top people, including the senior management level, senior manager level, everybody I have given training, almost more than 1,000 people have trained there. So that means it is already there. It is already there. Skill is already there. Only thing you have to tap sir, that who is the right person to conduct ESG training. Thank you, sir.
Okay, very good. Next. Governance question. Governance. Very important. Madam.
So, both the governance and talent questions merge well together. I'll tell you what's happening at the global level and then how it translates to India, right? Globally, there are multiple committees that are getting involved because frankly no one committee can anchor it. You're absolutely right. In India what happened is sustainability started say in the FS sector 10 years ago. At that time the CSR committee took up sustainability. Of late we've seen this phenomenon where the risk committee is taking up sustainability in FIs primarily. So that's it because it is a major risk RBI, I mean, the risk committee is going to be held accountable for it. So most companies are like, you know what, might as well have this risk committee take care of the entire sustainability agenda. I think in the FI sector specifically, that is most likely the best way to go. But there are two more committees, like the audit committee will, because of the reasonable assurance standards by SEBI for BRSR, the audit committee will also start looking at something on ESG. This is where these two committees will have to collaborate and review some of these findings together, although that's more internal. But I think there's a major criticism of BRSR the way it is today, which is it's sector agnostic. Sure. Yeah. It has to be the risk committee. Yeah.
But overall for the BRSR framework, which SEBI has,
Yeah.
which is India's
Yeah.
on ESG,
Correct.
that should come into perhaps the audit committee. But you don't feel there should be a separate ESG?
Not necessarily. Frankly, if you ask me today, is there as of date any audit committee that's doing ESG or BRSR? No. I believe that's a phenomenon that will happen because the assurance standards is effective this year. So this will take off, but frankly, it won't be a big agenda for the audit committee.
Sir,
It will mostly lie with the risk committee.
But Basu sir, in one of the company I was there, now I am not director, very great, big company. ESG committee separately
Yeah.
discuss 1 hour, 2 hour, presenting. It is a non-finance, non-finance sector. But risk management maybe, or even in the finance, your ICAP exercise when you do, this aspect in the risk management also will come. So any committee which is looking, including as he said, the audit committee, all the integrated approach has to be there. But the ESG committee specifically will be the best to get into the mode of deep discussion and guiding the other divisions and other activities. So, abhi anybody else has, because one question I can
So just a quick one on the talent. Same thing. I think talent and training needs to happen at all levels, starting with the board committee. The risk committee needs to have an independent director. There are specific trainings at the global level, global banks are doing, specifically for the risk committee members on sustainability. And this is not a one-time training. Every year.
That's where I was coming, because
Yeah.
I will be doing training for bankers as well as for insurance companies. But these are like, one-off. I'm there for a day, do my training, come out. But then what happens? Then there is no system or there is no continuation.
I believe there's regulation is what will push people, because you need to train the loan managers, you need to train every business division within a bank will change. I think when, we've been working on transition for many banks at the global level, I want to say it up front that it's a 2-year journey, minimum. First, where you do the strategy, then you train your teams, team by team, specifically the training is the pain point is when you train the risk teams and the relationship managers together, because the question is, you're telling them that when you go and ask a company, an SME for a loan, you need to ask these 10 questions in addition to what you've been asking. And they're like, why should I ask?
So,
how do I ask?
Yeah, with the audience requirement, I am getting the program another 10 minutes extended. So, Saudi, बताइए question आपका, Yunis? Hi. Sir, you have to come here.
Yeah, so few things are happening, right? One is most framework standards, they require quantitative data with evidence now. You look at BRSR, then other is assurance, right? More and more companies will come under the scope where they have to do some assurance on the data. So that overall is having a ripple effect of anti-greenwashing, right? And that trend will continue, right? Because there is a huge rep risk, also reputational risk for companies. So they are more careful now that they don't put something that's wrong.
Yeah. Okay. One Saudi or Naresh ji or Ajay Thakur ji, quick बताइए आपका sir question sir. Ajay ji, 1 minute. Yeah, make then.
So I got little bit confused here. USA has got highest carbon footprint. China has got even more carbon footprint than India.
but we are talking about global standards. Now, as far as India is concerned, and if you take SME sector in India, they have got huge problem. You know, the major problem that they are facing is the working capital. You know, they are not getting the payment on time, and we are saying that, okay, this company will judge this company on the basis of supply chain, and then they will give the point. Because you are not giving the payment on the time to the SMEs, and how you are going to judge and give the point to them. So I don't know what we are deliberating and discussing in the AC room, where the practicality is totally different. And the third point is that we have got billions of SMEs. How you are going to judge them? And at the same time, we are putting pressure on the banks to fund them. Are you going to judge them based on emission, or you are going to pay them for their survival and sustainability? So I think there are so many things that on which, you know, we have to deliberate, discuss, and then come on to the balance all those things, and then there are political and all those things are also involved.
Sir, I have to really, I have to.
अभी टाइम नहीं है मेरे पास. नहीं, आप एक क्वेश्चन पूछा, बाद में सर. नरेश जी, आपका क्वेश्चन.
I just wanted to ask, in the risk rating matrices, okay, which the currently we have, in the worst case scenario of a worst climate rating, what kind of impact it will have on a rating? For example, if it is a AAA rating company which has got a worst climate rating, what rating it will go down?
So at the moment, there's no climate rating. There are ESG ratings.
Yeah.
But I think just a caveat, I mean, ESG ratings are outside the purview of credit ratings. So that's what I was explaining initially. When we do credit ratings, we look at ESG, how it plays a role in the rating.
Do the pricing.
Sorry?
Then how do you do the pricing if there is a separate rating?
The investors themselves will choose.
Yeah.
They just need based on their mandate. We just the demand supply will take care of.
So the rating agencies don't say what color of green it is.
Internationally, there are certain agencies which are already giving rating to the corporate on the ESG.
Yeah, so
but that has to be extended to the climate area separately.
Correct.
ESG per se implementation is already getting rated, and the Indian corporates are also getting that rated through the international. तो अभी साहू साहब आपको एक क्वेश्चन आप ऑन करिए, उधर ऑन करिए.
I don't have question. I just have one view. No doubt, integration of all the department to have a successful implementation of ESG reporting. But keeping separate ESG department and the reporting should be separate. Then only it will be better. No doubt, ultimately the risk department will see the risk aspects or climate risk. But part of risk department will not have that successful implementation. That's my view.
No, you're right. I think the way, and this is where we learn the lessons from different organizations who've been doing it, right? The truth is ESG is a broad term. So far, there was a separate team that was doing it. Either it would be a separate team or it would be a part of the risk team, a part of the CSR team. I've seen companies in FS where the investor relations team, the compliance team is anchoring some of this. But moving forward, how this should diverge or this will diverge is there'll be one team that's doing reporting because it'll be a lot of work. Any department can't anchor it because you need to, ESG reporting requires interaction with 20 other departments internally because you have to source the data. I mean, BRSR, you're speaking to the CSR team, the HR team, the admin team, you need cross-sectoral, cross-stakeholder data. Reporting will be anchored by one team. You can call it the ESG team. They may report overall to the CRO or to any other, whoever's anchoring sustainability at the company level. It could be, not every company in FS globally has a chief sustainability officer. They don't. Typically, it's either the chief risk officer or the CFO or somebody else who's taking the responsibility for sustainability. So this team can report to them and work with them. But with that being said, the sustainable finance angle, the climate risk and strategy angle needs to be integrated within the product and business teams, the risk teams in the existing team.
That's right. But
Yeah.
separate sustainability officers will have a responsibility and the implementation of the.
भाई साहब आपको क्या बताइए सर, एक मिनट डेमोक्रेटिकली. हाँ, आपका क्या था?
I have to contradict him because earlier there are these payment terms for registered MSMEs
used to be, there was no limit. Now, this company used to hold payment for 90 days. Nowadays, there is a regulation that, मालूम है तो फिर, हाँ, yes.
किया उसको आपका इनकम टैक्स में यू हैव टू ऐड इट एज इनकम, ये तो आगे है, बट साहब ने बोलते इतना होने से भी कॉर्पोरेट देर करता है, वो अलग बात है। फाइनल रिपोर्टिंग टाइम में कोई आउटस्टैंडिंग नहीं, बीच में वो आउटस्टैंडिंग है। ओके, नाउ आई एम श्योर वन थिंग इज आई वाज लिटिल नो दैट दीज टू सब्जेक्ट्स आर वेरी टेक्निकल सब्जेक्ट। कैसा है हमारा ऑडियंस आएगा, कैसा प्रोग्राम होगा, ये तो हमारा मन में थे। एक है आपको राइट स्पीकर लाने का है, दूसरा है राइट ऑडियंस आने का है। तो आज का दिन में आप सबको हमारा ईएमसी से और आप सबसे भी टुगेदर लेट अस क्लैप बिकॉज वी हैव द राइट ऑडियंस एंड राइट स्पीकर एंड द डिस्कशन कैन टेक प्लेस स्टिल बिकॉज दिस सब्जेक्ट अभी इसलिए हमने बताया हमारे प्रेसिडेंट से, इसको एक दिन का प्रोग्राम करने का है ऑन द क्लाइमेट, पर्टिकुलरली ESG एंड क्लाइमेट रिस्क। Plus, of course, SRO also is evolving thing which is very essential and हमारा चारों स्पीकर्स है ना बहुत अच्छा कवर किया है, तो उनको भी हमने अभी नाम गेम बताने का जरूरत नहीं है, बट आप लाइक हमारा नवीन सूर्या, US पलीवाल, RK बंसल एंड हरिहर मिश्रा, उन्होंने उसका अलावा हमको थोड़ा स्पॉन्सर भी दिया है बंसल साहब और हरिहर से, तो उनको एक बड़ा क्लैप दे दिए। और दूसरा साइड में हमारा ही वाइस चेयरमैन PD सिंह का नेतृत्व में ये क्लाइमेट रिस्क के लिए, और पर्टिकुलरली हमारा सभी हीना मैडम हमने बहुत जगह में देखा है, उन्होंने इतने अच्छा बात किया है, और आज भी बहुत प्रैक्टिशनर में द आल्सो कंसल्टेंसी एंड ग्लोबल एक्सपीरियंस, इन्होंने अच्छा बात किया है। और हमारा साजल किशोर, बिकॉज रेटिंग एजेंसी बिकम्स वेरी रिलेवेंट इन दिस पर्टिकुलर एरिया, तो उन्होंने भी ग्लोबल उनका एक्सपीरियंस लाया है। और हमारा जितेश शेट्टी, ही इज बीन, उनका आपने सुना भी होगा, और उनका कॉर्पोरेट में भी है और फाइनेंस कमीशन में भी है, तो इसका इनको भी है, आप सब बड़ा क्लैप लीजिए। दूसरा हमारा प्रेसिडेंट समीर सोमैया साहब, और इसका DG और डिप्टी DG और हमारा सभी IMC स्टाफ इसमें बहुत सहयोग दिया। बट एक आदमी के लिए आपका बहुत बड़ा क्लैप में मांगता है, मिसेस भारती, शी इज हियर, शी डिड द एंटायर, शी इज इन चार्ज ऑफ द बैंकिंग फाइनेंस कमिटी, फुल प्लेज। और हमको बताते थे नरेंद्र साहब आप कुछ घबरा नहीं है, हमारा पास 100 रजिस्टर है और हम सब 100 आने वाला है, तो इतना मेहनत करके काम किया, इसके लिए हमारा उनको शुभकामना है। और दूसरा हमारा मीडिया, IMC का मीडिया सेक्शन डायरेक्टर भी है, और मीडिया से भी थोड़ा लोग आए हैं, और इसका बाद में उन्होंने मीडिया को भी फॉलो आगे दे देंगे। मीडिया के लिए भी हमारा शुभकामना और थैंक्स है, बिकॉज अभी हम थोड़ा हिंदी में भी इन्वॉल्व करने के लिए सोचा है, इसलिए हिंदी को बात करते हैं। दूसरा हमारा IMC का सपोर्टिंग स्टाफ, दे ऑल्सो डिड अ वेरी वंडरफुल जॉब, वी गिव अ बिग क्लैप टू देम ऑल्सो। अभी हमारा एक लास्ट प्रोग्राम है ऑन बिहाफ ऑफ द प्रेसिडेंट समीर सोमैया, I want to give a small souvenir to each one of them. Yeah. आइए, Mr. हरिहर जी, माधव नायर, कम, संदीप, आप आइए, आप भी दे दो, देखिए souvenir देने के लिए आइए आइए। Yes, आइए आइए, you can give, आप डालो ना, सब माधव जी, हाँ, अजय जी आप आते हैं, आइए आइए, नवीन को कम, अरे वी ऑल कमिटी